For millions of people around the world, this is not what if, this is reality. If you have following the previous sessions, you already know that we are not just learning theory, we are building a mindset, fintech mindset. So far, we have explored how fintech is reshaping the financial services, how business models are evolving, how technology is powering innovation, and how startups are disrupting this traditional banking. But today, we take a very important shift. Today is not just about innovation, today is about impact. Because the real question is, who are we building these financial solutions for? Millions of people around the world still don't have access to bank accounts, credit, insurance, even basic financial services. And that's exactly what today is about: financial inclusion strategies. In this session, we will explore how fintech is helping the unbanked, the underserved, and entire communities that were historically excluded from the financial sources. So, whether you are a future entrepreneur, a tech professional, or someone interested in creating a real impact, this session is for you. So, let's get started and let's explore how we can make financial accessible for everyone. But first, let's quickly recap our journey so far. In day one, we provided an introduction to fintech financial inclusion. Then in day two, we demonstrated how to deep dive into financial inclusion and provided insightful information. In day three, we explored the fintech business models. In day four, regulatory environment and compliance. In day five, we explored the technology foundations. In day six, we provided digital banking and payments. In day seven, we explored fintech startups and innovation. And in day eight, we provided innovations in financial services as we see here. This is from day 1 to day 11, and we will finalize our course by exploring how we can provide or create our capstone project. This is your graduation project from this course. Today, we will explore the financial inclusion strategies. This is where fintech becomes more than innovation, it becomes impact, because the real success of fintech is not measured by number of apps or applications or the amount of funding or the valuation. It is measured by how many lives it improves. And today, we will explore how financial sources can reach the unbanked, the underserved, and the invisible economy. So let me ask you a question. Can technology really solve financial inequality? Let's find out. So in today's session, we will focus on one of the most important missions in fintech, financial inclusion. And after completing this day, the participant will be able to first understand the inclusive banking models. So you will learn how financial institutions design services especially or specifically for people who don't have access to traditional banking. This includes simplified accounts, low-cost services, and alternative credit models. In microfinance, secondly, we will compare between the microfinance and microcredit and what will be the difference between them. So we will understand the definition of each terminology. In digital financial services, we will explore how mobile technology enables payment, savings, and lendings. In the mobile money and agent banking, you will understand how services like mobile wallets, local agents bring financial services to rural and remote areas. For example, such as M-Pesa revolutionized Africa, in Egypt Vodafone Cash. But the real goal today is not just knowledge, it's a perspective. To move from how does finance work to how can finance reach everyone. Inclusive banking models. In the financial inclusion, it is not just buzzword, it is about empowering individuals and communities. The strategies of financial inclusions act as roadmaps aiming to bring everyone into the formal financial system. And imagine a world where everyone has access to bank accounts, credit, financial tools to manage their finance, build wealth, and weather unexpected events. The innovations in financial services will help expanding access to banking services. So through mobile banking, agent networks, and microfinance finance institutions to reach remote and rural areas. Building financial literacy is very important to educate individuals on how to build their own budgets, how to save money, and how to make a responsible borrowing. In the consumer protection, we aim to safeguard users from unfair practices and ensuring transparency. In the digital innovation, leveraging technology will make financial services affordable and accessible. What is the difference between microfinance and microcredit? Microcredit specifically refers to small loans provided to individuals or groups typically excluded from traditional bank systems. Amounts range from $50 to $50,000, where is being used for microcredit. This will be used for short-term goals like starting small businesses, primarily focusing on expanding access to credit. While microfinance is a broader term encompassing microcredit and additional financial services, including saving accounts, insurance, and money transfers, caters to both short-term and long-term goals, aims for financial inclusion, bringing individuals into the formal financial services. Whether microfinance or microcredit, to compare between them, we will compare between them from the business model perspectives, where we are here illustrating the 9 building blocks for each business model, starting from customer segments, value proposition, channel, customer relationships, revenue streams, key resources, key activities, key partnerships, and cost structure. Let's start. If we are comparing between microfinance and microcredit, let's start from the customer segments. In microfinance services targeting low-income individuals, micro-entrepreneurs, small businesses, while microcredit is targeting primarily low-income individuals starting or growing micro-enterprises. And the value proposition of microfinance is to access to a range of financial services such as savings, loans, insurance, money transfers, financial inclusion, while microcredit value proposition is to access to small loans for starting or growing micro enterprises. If we are talking about the channels of microfinance, branch networks, agent networks, mobile banking, but in microcredit, branch networks, agent networks, mobile banking, so they are the same and they have the same channels. The customer relationships in microfinance managed through group-based lending models, individuals' relationships with loan offers, with loan officers. In the microcredit, primarily individual relationships with loan officers. Revenue streams from the interest or loans, transaction fees, account maintenance fees. In microcredit, interest on loans. Key resources is human capital, loan officers, financial educators, technology team, branch agent network infrastructure, IT infrastructure, disruptive technology such as artificial intelligence, machine learning, mobile applications, and data analytics. And it is the same as microcredit key resources. And the key activities, they are almost similar, as the key activities will be credit check, loan origination, account management, financial education, product development, research and development, develop new features and functionalities. In the micro credit, there is no account management or financial education or product development, but they differ from microfinance in loan collection and monitoring loan performance. The key partnership: NGOs, government agencies, other financial institutions, technology providers. where microcredit is limited to NGOs, government agencies, other financial institutions. Cost structure, it is almost the same as cost structure elements or cost elements from staff costs to branch agent network maintenance, software and hardware acquisition cost. But in microcredit, there is a loan loss provisions. This is an additional cost element in this business model. The key differences between microfinance and the microcredit, the value proposition. Microfinance offers wider range of services while microcredit focuses solely on loans. In the revenue streams, microfinance have diversified revenue streams, however, or while microcredit primarily relies on loan interest. In customer relationships, microfinance can involve group-based models, while microcredit typically focuses on individual relationships. Cost structure, microfinance may have higher cost due to wider range of services offered. Community banking, InsurTech, RegTech, and other emerging sectors. We can see that community banks hold a special place in the financial landscape, offering a distinct alternative to larger national institutions. Here is what sets them apart. Local focus. So community banks are deeply rooted in the communities they serve. They typically have a limited number of branches concentrated in a specific geographic area, allowing them to develop personal relationships with customers and understands their unique needs. Personalized services, unlike the automated and standardized processes of large banks, community banks prioritize individual attention. You will be likely to encounter familiar faces and enjoy local customized support for your financial goals. Community banks have more leeway in assessing loan application, which can be beneficial for small businesses and individuals who might not qualify for loans from larger institutions due to stricter criteria. So there is more flexibility in community banking. Community banks are often actively involved in supporting local initiatives and businesses, investing their resources back into the community they serve. This fosters economic development and strengthens the social fabric. And while not always the case, community banks may offer competitive rates on savings accounts and loans, and their fee structure can be more transparent and customer friendly compared to larger banks. There is a limited products and services in the community banking, and there is a potential drawbacks. So if we are comparing larger banks versus community banks, there is the community banks offering narrow range of products and services, and the community banks is provided within the local areas, but not out of these local areas. Community banks is also more convenient to local individuals. While many community banks are embracing digital solutions, some may lag behind larger institutions in terms of technological advancements. Partnerships of financial inclusion. We have many types of partnerships, such as public-private partnerships. So governments can provide policy frameworks, subsidies and infrastructure development, while financial institutions offer expertise and financial products. Government and combining government resources with innovative fintech solutions can reach remote areas and offer tailored financial services. NGOs can provide financial literacy training and community outreach, while financial institutions offer products and services. And leveraging mobile networks can expand access to financial services in areas with limited banking infrastructure. Collaboration can enhance product offering and service delivery, leveraging each other's strengths. And regular banks can provide funding and technology, while microfinance institutions offer experience and understanding of underserved communities. The partnerships can reach wider, more diverse populations, and the collaboration can lead to new financial products and services tailored to specific needs. Sharing resources and expertise also will improve efficiency and mitigate the risks, and partnerships can attract funding and ensure long-term impact. Partners will need to have shared goals and objectives to have more alignment. Ensuring equitable participants and benefits for all partners will increase the power dynamics. Tracking the impact and effectiveness of partnerships is one of the challenges that we will need to overcome. So we have three challenges here: alignment of interests, power dynamics, and measurement and evaluation. As an example for successful partnership, there is a partnership between Grameen Phone and Grameen Bank. This provides microfinance services through mobile banking in Bangladesh. Action International and Mastercard expanded the access to financial services for underserved communities in Latin America. Maya Bank in Philippines and Smart Communications offered mobile-based financial services to Filipinos. Digital financial services for the underserved. Sending money safely, saving for future, and managing finance become accessible through individuals' empowerments. Micro entrepreneurs gain access to credit following business growth by posting livelihoods. Remote communities are connected to the financial systems, unlocking opportunities, help in promoting financial inclusion. By developing user-friendly platform, this will help in simplifying design and local language, ensuring inclusivity, also addressing affordability and security concern by building trust and making services accessible to all. To promote financial services, we can educate individuals to make them informed by all financial decisions. Mobile money and agent banking. You deposit cash at an agent, it gets converted to digital money stored on your phone. So you can then use it for various transactions like sending money to family and friends, paying bills for utilities or groceries, buying goods and services at shops, accepting mobile payments, saving money for future needs. Agent banking, such as local shops or kiosks, become mini banks offering essential services like cash, bill payments, and airtime top-ups, account opening, and assistance with mobile money transactions. The real benefits is financial inclusions, where we can reach unbanked populations in remote areas, promoting financial independence, convenience through accessing financial services anytime, anywhere with your mobile phone, security, where your transactions are encrypted and secure, reducing reliance on carrying cash, economic growth through creating jobs for agents, simulates local businesses accepting mobile payments. Challenges demonstrated in limited literacy and digital skills, and this requires education and awareness programs for wider adoption. Network connectivity issues is one of the main challenges in the rural and remote areas, and this can be solved through stable internet and mobile coverage, where the connection is very crucial for smooth transaction. The data privacy concerns is one of the biggest challenges. So we need to ensure that the data is secure, so the user can trust the service, and this trust is very essential for the success of financial inclusion. If we are illustrating here the business model of mobile money and agent banking, the targeted customer segments underbanked or unbanked individuals, micro, small businesses, government agencies. The value proposition that will be provided is financial inclusion, convenience, security, affordability. Additional services will be provided. The channels is mobile network, applications, agent network, retail stores, and merchants. The relationships with the customer will be managed through self-service portal, agent interaction, customer service hotline. The revenue stream will be represented in transaction fees, cash in, cash out fees, merchant fees, value added sources. The key resources will be mobile network infrastructure, mobile money platform, agent network, and partnerships. The key activities is platform development, maintenance, agent recruitment, training, management, customer acquisition, education, compliance, regulatory management, partnerships, and collaboration. The key partnerships through MNOs, financial institutions, regulators, technology providers, and the cost structure. The elements will be represented in technology costs, agent network costs, marketing and acquisition costs, compliance regulatory costs, and transaction processing costs. Digital identity and KYC solutions. Digital identities is referring to electronic representation of an individual's identity attributes such as names, address, date of birth, and biometric. And this information can be stored and transferred securely online, facilitating various interactions, including opening bank accounts, addressing financial services, making online payments, fighting fraud and money laundering. What are KYC solutions? They are regulatory requirements for financial institutions to verify the identity of their customers and assess their own risk profiles. These solutions leverage technology to automate and streamline the processes of onboarding new customers, and these solutions should make the KYC process faster and more efficient through automated checks to reduce manual work and expedite customer onboarding. It should be more secure through using biometric authentication and tamper-proof document verification that will help in enhancing security, more convenient by verifying customer identities through remote check using smartphones or other devices, more inclusive as digital solutions can reach remote areas and under or unbanked populations. The types of digital identity and KYC solutions. First, we have document verification that use the AI and machine learning to validate identity documents like passports or driver licenses. Biometric authentication through utilizing fingerprints, facial recognition, or iris scans for secure user verification. Liveness detection through ensuring the user is physically present during verification and not using deepfake or pre-recorded videos. Digital onboarding through completing KYC checks entirely online, eliminating the need of physical visits. And the benefits of these solutions is enhancing security by reducing fraud and money laundering activities, faster and more convenient onboarding process, so it is improving the customer experience, financial inclusion by bringing more people into formal financial systems, cost saving by automating manual tasks and reducing operational costs for financial institutions, and it helps in making organizations compliant with regulations by adhering to KYC regulations efficiency. The challenges and considerations: privacy concerns through balancing security needs with data privacy rights of individuals. We have technology access challenge, so we need to ensure that there is an inclusivity for populations with limited access to technology. It will be impacted. Standardization is one of the challenges, and there is a need for global standards for interoperability and data exchange. The future of KYC solutions, that they are rapidly evolving with constant advancements in technologies like biometrics and blockchain. These solutions will become more sophisticated and secure. They have potential to create more inclusive and efficient financial systems to benefit the individuals and institutions. The impact, investing and social responsibility. Impact investing, core focus on generating financial returns alongside measurable positive social and environmental impact. Investment strategies, so through targeting some areas like renewable energy, affordable housing, sustainable agriculture, and social enterprises. We have some metrics such as rigorous measurement and reporting for both financial and social environmental impact. Social responsibility, the core focus on businesses integrating social and environmental considerations into their core operational and decision-making. Strategies will focus on implementing ethical labor practices, reducing environmental footprint, supporting local communities, and promoting responsible supply chain. And the metrics will be demonstrating commitment through transparent reporting and adherence to relevant standards for and frameworks. The synergetic power, there is an impact on investors that they can leverage the reach and resources of social responsible business to scale their positive impact. Socially responsible businesses can attract impact investors seeking aligned values and generate additional capital for sustainable practices. The benefits of partnership is increasing the capital flow for positive impact by combining resources, expands the pool of funds available for addressing social and environmental challenges, enhanced innovation through collaboration that foster new solutions and approach to tackle complex issues, great accountability and transparency through some approaches that emphasize on responsible practices that will lead to more ethical and sustainable business model, long-term societal benefits by addressing systematic challenges. This partnership contributes to more just, equitable, and sustainable future. Balancing financial and returns with social impact is one of the challenges and considerations. By finding the optimal balance between profitable and positive impact can be complex. The next challenge is measuring and verifying impact, where accurately measuring the reporting social environmental impact remains an ongoing challenge. Avoiding misleading claims and ensuring genuine commitment to social responsibility is crucial. So we have a greenwashing and lack of transparency. Businesses embracing social responsibility will attract more impact investors and vice versa, and this will be a greater integration of the approaches of different between the different approaches, tailored offering catering to the specific needs of impact investors and socially responsible businesses will help in developing the innovation of financial products. Standardization of metrics and the frameworks will enhance transparency and accountability, and this will lead to increased focus on impact measurement. We reach to the last part where we will ask you a few questions to review what we illustrated in our today's lecture. Let's start with the first question to help us remember what we said today. What is the primary goal of microfinance? Is to provide large loans to businesses in developing countries, to offer small loans and financial services to low-income individuals and entrepreneurs, to invest in major infrastructure projects in emerging markets, to facilitate international trade transactions between developed and developing countries. Yes, to offer small loans and financial services to low-income individuals and entrepreneurs. What is the key difference between microfinance and microcredit? Microcredit only focuses on loans, and microfinance offers a wider range of microservices. Microcredit provides larger loans compared to microfinance. Microfinance targeting individuals, while microcredit focuses on groups. There is no significant difference between the two terms. Microcredit only focus on loans, yes, but microfinance offers a wider range of financial services. What is a key benefit of mobile money for the underserved? Is it access to high interest saving accounts, convenience and security for sending and receiving money without traditional bank accounts, complex investment opportunities in global markets, long-term loans for large businesses? Convenience and security for sending and receiving money without traditional bank accounts. What is the main function of agent banking in digital financial services? Developing and maintaining the mobile money platform, provide physical touch points for cash deposits, withdrawals, and other sources, regulating and overseeing the entire digital financial services ecosystem, educating users about financial literacy and responsible money management. Yes, providing physical touch points for cash deposits, withdrawals, and other services. What is the challenge associated with digital identity solutions for financial inclusion? Lack of awareness and trust among potential users, limited access to technology and internet connectivity in remote areas, over complex or overly complex verification processes requiring specialized equipment, abundance of regulations and compliance requirements for different countries. Thank you very much. Limited access to technology and internet connectivity in remote areas. What is the primary objective of Know Your Customer or KYC solutions? To provide personalized recommendations for financial products, to verify the identity of customers and assess their risk profiles for regulatory compliance, to offer loyalty programs and reward frequency users of financial services, to track spending habits and analyze customer behavior for marketing purposes. The primary objective of KYC solutions is to verify the identity of customers and assess the risk profiles for regulatory compliance. What is the main benefit of impact investing for businesses? Accessing lower interest rate for traditional loans, attracting investors who share their values and commitment to positive impact, reduce overall tax liability through charitable donations, avoiding any regulations or restrictions on their business operations. The benefit of impact investing for businesses is to attract investors who share their values and the commitment to positive impact. What is the potential challenge for collaboration between impact investors and the socially responsible businesses? Lack of transparency, no, and clear reporting for social environmental impact, balancing the pursuit of financial returns and achieving measurable positive impact, difficulty finding qualified professionals with expertise in both financial and social impact, limited pool of available capital dedicated to impact investing initiatives. Thank you very much. Balancing the pursuit of financial returns with achieving measurable positive impact. What is the main purpose of business model canvas? To create detailed marketing plan for new product or services, to visually represent and analyze the key components of businesses, to attract potential investors through financial projections and fundraising strategies, to develop legal and regulatory compliance documentation for a new business venture. Yes, to visually represent and analyze the key components of a business. The last question here today, what is a key difference between community banks and large national banks? Community banks offer higher interest rate on saving accounts. Community banks typically have limited geographic reach and focus on personalized services. Large national banks offer a wider range of investment products and sources. Community banks are less regulated and subject to stricter financial oversight. Yes, community banks typically have limited geographical reach and focus over or on personalized services. So today we didn't just learn financial models, we learned how to include people in the financial system. So we explore the inclusive banking models, microfinance versus microcredit, digital financial services, digital mobile money, and agent banking. And most importantly, we understood that access is everything, because here is the truth. Being unbanked is not just a financial problem, it is life limitation. So think about this. What services do you take for granted today? And how would life be without them? That's the reality of millions of people. And in the next section, or in the next session, we move from strategy to real world case studies, from concepts to execution. Traditional banks, please, in the traditional banks, they say for you, please visit the branch between 9 to 2 p.m. with 7 documents, while in Fintech applications, you will see a verified sign in 30 seconds. That's literally the difference between exclusion and inclusion. When you finally open bank accounts after 3 weeks, and your friends already send money using mobile wallets in 5 seconds, speed, it is not luxurious option anymore. It is access. No bank account, no problem. Fintech is already here. And that's the whole idea of financial inclusion. If you found this session is valuable, please share it with someone interested in Fintech, subscribe to Teqnyat, and start thinking how can you build solutions for the underserved. Because the future of finance is not about serving the privileged, it is about reaching everyone. Thank you very much for following us today, and see you in the next session, and goodbye.